Chris, before we get to the picks, I want to talk about the Fed, because actually everybody was tripping over themselves to try to identify when or how many rate cuts there may be. I'm actually reading stuff now. There were some articles out this morning that maybe people are starting to talk about rate hikes once again because of what happened in January. Where do you stand?
You know, Brian, it's good to be back with you. I'd say a couple of things. First of all, it's completely non-consensus to say that the economy might actually be getting stronger. But it may be non-consensus, but it does seem to go along with the current data. I mean, we're seeing job reports that are the best in a year. The market, which is, of course, a discounting mechanism, is up over 20% since October. Average hourly earnings are starting to go up again. Even the real negative stuff, like the PMI reports, which have been declining for almost 2 years, have now set their highest level in a year. They're still crummy, but they used to be abysmal, and now they're back to crummy. So the point is, there's lots of indicators that are turning upwards. So what do you do with that? Well, my position is, why would the Fed want to add the stimulus of rate cuts to an already accelerating economy? So that's problem number one. But problem number two is deeper, which is that, you know, this kind of strength can easily lead to inflation, which isn't entirely flushed from the system. So we have those specters that investors thought were in the rearview mirror. So now, instead of talking about a credit squeeze or a credit crunch like Steve was, we're actually talking about the opposite problem, which is expansion, and an expansion that may be a little too fast for the Fed.
Yeah, a little bit too fast. All right, but listen, in any environment, and if we see a change in the rate environment, to your point, different things may do well. So let's talk about some stocks. And as many of our viewers, at least on my show at 7 o'clock Eastern, and maybe from my posts or other stuff, they know that I've had a, I think, fair, but many would call it critical eye toward the EV build-out, not because I dislike EVs. I've owned one. I've driven many. It's just that there's a lot of things I think people did not think about, and people kind of blindly bought into companies that are anywhere on that supply chain. Unfortunately, a lot of those companies have lost a lot of people a lot of money, but at some point they either stopped going down or worse. You believe that Albemarle, which is the biggest lithium producer in the United States, kind of the gasoline of the EV revolution, if you will, finally may have found a bottom here, because it's been brutal.
I do. There's a couple of reasons for that, Brian. So we look for 30 years at the price action of Albemarle. 2 times previous to now, it's gone down about 65% in lithium, declines. This time, they're down about 65 to 70% again. So that's kind of where it finds a floor. The price to sales, the price to book, they're all kind of at the floor levels. You don't go on price to earnings because you know as well as I, those are going to disappear in a crummy market like now. But what we're doing is buying it for 2 to 3 years from now. To me, Brian, this is like buying oil 3 years ago when it couldn't catch a bid, when nobody wanted the stocks. So I think get in now. And remember, you've been completely right on the EVs. It was a terrific call. But outside the United States and China and Europe, they're still going like gangbusters, and they will turn here. If you get some oil, gasoline prices that are going up, things like that, but we think that we're bouncing along the bottom in terms of EV negativity.